WGAN Forum Podcast number 196. Tuesday, May 16, 2023.
This WGAN Forum podcast is sponsored by the We Get Around Network Forum, your source for Matterport and related 3D and 360 platforms, cameras, and third-party add-ons. Visit WGANforum.com.
Matterport, Incorporated. Filed Form 10K with the U.S. Securities and Exchange Commission on Thursday, April 27, 2023.
Part 7. The following excerpt is from pages 21 through 28 of the 10K, Matterport Risk Factors, continued. The entire 10K is available at wgan.info/10K.
Our channel partners could subject us to lawsuits, potential liability, and reputational harm if, for example, any of our channel partners misrepresents the functionality of our platform to customers or violates laws or our or their corporate policies. In addition, in circumstances where we do not enter into a direct agreement with end customers, we cannot be sure that on every occasion each channel partner has required end customers to agree to our standard terms which are protective of our solutions and technology, nor that the channel partners will enforce each failure by an end customer to comply with such terms. Our ability to achieve revenue growth in the future will depend, in significant part, on our success in maintaining successful relationships with our channel partners, identifying additional channel partners, and training our channel partners to independently sell access to our platform. If our channel partners are unsuccessful in selling access to our platform, or if we are unable to enter into arrangements with or retain a sufficient number of high-quality channel partners in each of the regions in which we market and sell our platform and keep them motivated to market and sell our platform, our business, financial condition, results of operations, and growth prospects would be adversely affected. Our business strategy includes growing our portfolio through potential future acquisitions, strategic investments, partnerships, or alliances that could be difficult to identify and integrate. Such projects may divert the attention of key management personnel, disrupt our business, dilute our existing stockholders' value, and adversely affect our financial condition and results of operations. As part of our business strategy, we have in the past acquired, and may in the future acquire, additional assets, products, technologies, or businesses that are complementary to our existing business. The process of identifying and consummating acquisitions and the subsequent integration of new assets and businesses into our existing business would require attention from management and could result in a diversion of resources from our existing business, which in turn could have an adverse effect on our operations. Acquired assets or businesses may not generate the expected financial results. Acquisitions could also result in significant cash expenditures, potentially dilutive issuance of equity securities, amortization expenses for other intangible assets, exposure to potential unknown liabilities of acquired businesses, and potential goodwill impairment. We may not successfully evaluate or use the acquired technology or personnel, or accurately forecast the financial impact of an acquisition transaction, including accounting charges and tax liabilities. Further, the issuance of equity or securities convertible to equity to finance any such acquisitions could result in dilution to our shareholders, and the issuance of debt could subject us to covenants or other restrictions that would impede our ability to manage our operations. We could become subject to legal claims following an acquisition or fail to accurately forecast the potential impact of any claims. Any of these issues could have a material adverse impact on our business and results of operations. Failure to successfully identify, complete, manage, and integrate acquisitions could materially and adversely affect our business, financial condition, and results of operations. On January 5, 2022, we consummated the acquisition of 100% of the issued and outstanding equity interests in InView, Inc., a privately held company engaged in the development of artificial intelligence algorithms to identify natural and man-made features in geospatial data using various techniques, for an aggregate purchase price of approximately 1.59 million shares of the company's Class A common stock, par value $0.0001 per share, and $35.5 million in cash. In addition, we completed the acquisition of VHT, Inc., known as VHT Studios, a U.S.-based real estate marketing company that offers brokerages and agents digital solutions to promote and sell properties, which expands Matterport capture services by bringing together Matterport digital twins with professional photography, drone capture, and marketing services. The completion of these acquisitions does not guarantee that we will ultimately strengthen our competitive position or achieve our goals or expected growth, and the acquisition could be viewed negatively by our customers, analysts, and investors, or experience unexpected competition from market participants. Any integration process may require significant time and resources. We may not be able to manage the process successfully and may experience a decline in our profitability as we incur expenses prior to fully realizing the benefits of the acquisition. We could expend significant cash and incur acquisition-related costs and other unanticipated liabilities associated with the acquisition, the product, or the technology, such as contractual obligations, potential security vulnerabilities of the acquired company and its products and services, and potential intellectual property infringement. In addition, any acquired technology or product may not comply with legal or regulatory requirements and may expose us to regulatory risk and require us to make additional investments to make them compliant. Further, we may not be able to provide the same support service levels to the acquired technology or product that we generally offer with our other products. Additional risks we may face in connection with acquisitions include diversion of management time and focus from operating our business to addressing acquisition integration challenges, coordination of research and development and sales and marketing functions, integration of products and service offerings, retention of key employees from acquired companies, changes in relationships with strategic partners as a result of product acquisitions or strategic positioning resulting from acquisitions, cultural challenges associated with integrating employees from acquired companies into our organization, integration of acquired companies' accounting, management information, human resources, and other administrative systems in our existing operations. The need to implement or improve controls, procedures, and policies at a business that prior to acquisition may have lacked sufficiently effective controls, procedures, and policies. Additional legal, regulatory, or compliance requirements. Financial reporting, revenue recognition, or other financial or control deficiencies of acquired companies that we do not adequately address and that cause our reported results to be incorrect. Liability for activities of acquired companies, including intellectual property infringement claims, violations of laws, commercial disputes, tax liabilities, and other known and unknown liabilities. Unanticipated write-offs or charges, and litigation or other claims in connection with acquired companies, including claims from terminated employees, customers, former stockholders, or other third parties. Our failure to address these risks or other problems encountered in connection with acquisitions and investments could cause us to fail to realize the anticipated benefits of these acquisitions or investments, cause us to incur unanticipated liabilities, and cause other harm to our business. We may need to raise additional funds to finance our operations, and these funds may not be available when needed. We may need to raise additional funds in the future to further scale our business and expand to additional markets. We may raise additional funds through the issuance of equity, equity-related or debt securities, or by obtaining credit from financial institutions. We cannot be certain that additional funds will be available on favorable terms when required, or at all. If we cannot raise additional funds when needed, our financial condition, results of operations, business, and prospects could be materially and adversely affected. If we raise funds through the issuance of debt securities or other loan transactions, we could face significant interest payments, covenants that restrict our business, or other unfavorable terms. In addition, to the extent we raise funds through the sale of additional equity securities, our stockholders would experience additional dilution. We expect to incur research and development costs in developing new products, which could significantly reduce our profitability and may never result in revenue. Our future growth depends on penetrating new markets, adapting existing products to new applications and customer requirements, and introducing new projects that achieve market acceptance. We plan to incur significant research and development costs, R&D, in the future as part of our efforts to design, develop, manufacture, and introduce new products and enhance existing products. Our R&D expense was approximately $85 million and $55.4 million for the years ended December 31, 2022 and 2021, respectively, and is expected to grow substantially in the future. Our R&D efforts may not produce successful results, and any of our new products may not achieve market acceptance, create additional revenue, or become profitable. We operate in a new market, and global economic conditions and instability related to COVID-19 and otherwise may adversely affect our business.